Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and of course one of the founding partners of the Dividend Kings marketplace service here on Seeking Alpha. And I've been in the security business for really going on 50 years, since 1970, and I will tell you that over all those years I found that being in this business can be at times a very, very humbling experience. And the one time I perhaps was humbled the most was when I produced an article in January of 2018 as a subscriber request or a reader request. I had several readers following my work here on Seeking Alpha ask me to do an article on the healthcare distributor Owens Minor, and I hadn't looked at the company in years. So what I decided to do, I go ahead and meet their request and do the article. And here's the video and what the company looked like when I first published that article. As you can see, the article was posted on January 26, 2018. And Owens Minor looked like a really great investment opportunity at that time. It was a dividend contender under the then David Fish, who was the curator of the CCC list, the Champions, Challengers, and Contenders list, now who's taken over by Justin Law, of one of my associates at Dividend Kings. But nevertheless, the company looked really good. It wasn't much of a growth story. It had a growth rate of about 8.9%. The stock price, moderately cyclical, had gone through several flat years here. You can see earnings growth was pretty flat during these years, from 2009 all the way to 2018 when I actually published this article. And you can see that they had a down year of earnings and the stock price fell, but estimates at that time were quite strong. It's kind of interesting. This is the old version of FastGraphs. So the company looked really undervalued, and it also looked like it was starting to move back into alignment with its earnings. It had a little, uptick here. It looked intriguing. It was offering a 4.7% dividend yield. At that time, it was BBB minus, one step away from investment grade, with about 47% debt to capital. So I thought the company looked pretty attractive, and I was actually delighted to write about it. And I did. But lo and behold, here's what happened on that unbelievable day when I actually wrote about the company, as again on January 24th, 2018. Instead of having the earnings growth that we saw for 2018, 19, and 20, we saw 2017 earnings actually end up falling by 21%. 2018 fell by 29%, and then 2019's earnings actually fell by 48%. So up to this point, we saw the stock price fall. I'll find that spot. This is January of 2018. I only have monthly closings on the graph. So this is about a week after I wrote the article, and as you can see, that the stock price originally fell precipitously. It was down over 84, almost 85% from peak to trough. And this is pricing it at $3.20. The price actually got down to $2.43. So this was an incredible collapse. Here's what's interesting about this. The company's earnings, there was a lot of reasons. They lost a major contract. The healthcare distributors were under a lot of pressure. Generic drug pricing was weak. There was the opioid crisis that was really affecting all these companies. And as I kind of pointed out in the written portion of the article, you had almost every company in this industry, AmerisourceBergen, also saw its stock price drop. We had names like McKesson, etc. So I've got copies of those in the written portion. You could go back and check them. So all these drug distributors saw their prices drop precipitously. The difference was those companies' earnings, as you just saw with AmerisourceBergen, continued to grow. But what happened with Owens Minor is their stock price and their operating results collapsed. And the company then that was a dividend contender at the time and on track to become even a dividend champion, which is 25 years or more of dividend increases, slashed their dividend from $1.03 down to 86 cents, and ultimately to where it is today at $1. So it no longer became a dividend stock. But what's really interesting about this, this was the price, approximate price. It was trading at around $21 a share when I did the video. If we go back to the video, it was actually $21.74. So this is about as close as I can get to that $21.06. If I actually measure that to today, now the stock today had a very excellent day so far. The price of Owens Minor is up about 3.63% today. The stock is trading at 27.25 as I produce this video. So the bottom line is, if you take that up to the $27 price, which is right here, which will be the end of the year this year, this stock, from the time I wrote the article to now, would be generating, today, if you owned it today, you'd be earning about a 10% annualized rate of return over that time frame from 2018, 19, and then of course into 20. So you're looking at 2.5 years, you're averaging over 10%, or just at a 10% compounded rate of return. But the road to that 10% return was obviously very treacherous. A 90% loss, ultimately recovered, and I think we had like a 40-some% surge, 47% surge in one day after the company started, showing these earnings recoveries. And I talked about that. They revamped their management team. They made some acquisitions. They're announcing a divestiture. They're going to be raising some additional stock, but the earnings have just exploded to over 200% expectations for this year, and then followed by, a pretty good year the next year, and then we're all looking at a down year in earnings again. But I want to stay on this forecasting for a while. What I've got here is I've got the forecast for the next 3 years that I just showed you. So we've got a 200% increase expected for this year, and the company just basically corroborated that. They say they're on track to do that or better. And then that's followed by a double digit. And then, the analysts do expect the company's earnings to falter a little bit in 2022, but the long-term trend line growth is expected to be over 44%. Now, we get our data from FactSet here on Fast Graphs, but I also check other sources. So I'm going to go here to Yahoo Estimates here, which gets their data from Reuters. And I want you to notice that the next 5-year estimate for the Reuters analysts following the stock is 45%, or very, very similar to the 45 or 44%, 0.33% that we're showing here on FactSet. So this would mean that this company would have some tremendous long-term opportunities from here, because it would be, again, very undervalued, assuming these analyst estimates are right. But keep in mind, the scorecard was abysmal for these 3 years. We were showing in 2018, when I did the first article, we were expecting $1.98, we got $1.61. That was a minus 37% difference. We were expecting $2.10, it went down to $1.15, and then for 2019, we were expecting $1.03, and it went to 60 cents. So, now we're expecting 73 cents from the 60 cents, and hopefully we'll see, that number come to pass. But again, the company went through a tremendous transformation, which I talked about. And, they've revamped their management team. They've made some acquisitions. Those acquisitions are bearing fruit. So the company's starting to look pretty interesting. So I want to turn to fund graphs here a little bit and look at what's happened. All through this is the revenue line, the top line. Revenue's faltered a little bit. But if I just kind of focus on those last few years here that we wrote about, if I'm looking at 2018 and 19, revenues, dropped very, very slightly from 9.4 billion to 9.21 billion, but they stayed pretty much on track. All right. Now, if I go into the quarterly results, through June of 2020, revenues were falling. But there have been some tremendous improvements on the balance sheet as well. And one of the things that I want to look at is I want to go ahead and look at debt. So let me get rid of the revenue here, and let's look at debt. The company is talking about deleveraging the balance sheet. And so if we look at long-term debt, the company for the last 6 quarters has actually been reducing their debt. It went from 1.8 billion to 1.38 billion. So it's actually reducing its debt slowly but surely, and the company's going through, that's all part of their transformation. Another balance sheet item I think that's very, very important that I want to focus on is cash. The company has had a lot of cash on the balance sheet all through this whole debacle. So let's look at the annual numbers first. And I'll go ahead and expand this out. The company in 2016, 17, and 18 actually had some decent cash on the balance sheet. It was dropping, though. It had dropped from 185 million down to 66 million. And then 2019, it kind of recovered a little bit to 67 million. But once again, if we look at the last couple of quarters, for the June quarter, it went back up to 180 million. So the company is kind of going through a resurrection, if you will. They're growing again. The business is looking strong. As I showed you earlier here with these fast graphs and looking at, the forecasting graphs, the forecasts are really strong. Now, if I look at the actual specific estimates, I do want to remind you, we're looking for a $1.80 right now. Now, the estimate 6 months ago was 55 cents. So obviously, the analysts are seeing tremendous improvement that the company's been announcing and reporting. So 6 months ago, they're expecting 55 cents. Most recently now, they're expecting $1.80, which would be a 200% increase from the 60 cents they earned in 2019. And then they're expecting another 12%. But then now it drops off from 7 analysts to 4 analysts, expecting a negative growth rate in 2022. But when I look at the trend line, 3 to 5 year trend line growth rate, is for 44%. So I've combined these two estimates now. These are the specific estimates for these next couple of years, and then I'm simply extrapolating that at the long-term growth rate, and the numbers look, quite extraordinary. So the company would be significantly undervalued. Anyway, it's been a remarkable story. It's been a remarkable comeback. The company's current credit rating is B+. That's down from BBB-. Hopefully it's, with all the improvements here, we're going to see it, resurrecting itself. If I look at things like operating cash flow, which I did in the first video, I do want you to notice that operating cash flow has been improving dramatically. And that's, I think, one of the things that have, brought the stock price back up to a more rational value. The company was always generating pretty good cash flows. They did get, pretty weak in 2014. They were kind of weak in 2017, but they were actually pretty good in 2018 in spite of the fact that the earnings went down. Anyway, the company did slash their dividend. Their free cash flow also was performing pretty well during this time frame. It's expected to kind of stay in line with the operating cash flow, if you will. So, there's a lot of things that are very interesting about this company. But anyway, at the end of the day, the reason I presented this again and did an update on this was one of the most humbling experiences of my career. I was originally presenting this as a research candidate for dividend growth at a significant undervaluation. Of course, things have obviously changed dramatically, but now they've changed again to the positive. So it's a very interesting story, and I hope you enjoyed going through it with me as much as I enjoyed going through it for you. Anyway, this has been Chuck Carnevale saying thanks for watching.